So we take the shares which were acquired, which basically is what we have there here, 3 million. We divide that with the shares which are issued by this company, which have computed up there. And that will give us what? That will basically give us 30%. That will give us 30%. It basically means that this company here, that is 𝐻𝐻𝐂𝐔𝐒, is a subsidiary, whereas now 𝐍 Limited will be an associate, because we said anytime the parent company has acquired shares which are more than 50, actually which lies between 51% to 100%. So the investee company is a subsidiary. But if the parent company acquires shares which lies between between 20% to 49%, the investee company is what? The investee company is an associate. So therefore, this is a subsidiary. This is what? This is basically an associate. So having said, I think we can come up with a group structure here. Maybe let me just copy this. So we have this as our parent, and actually the parent company here acquired 80% shareholding. This one acquired 80% shareholding in the company which is called, so this one acquired 80% shareholding, 80% shareholding. And remember, you also have the date of acquisition here, this one, 1st July 2022. Maybe you can also transfer that up there, where we have our group structure, where we have the group structure there. So this is a subsidiary, that is 𝐻𝐻𝐂𝐔𝐒. Yes, we have it here. Yes, so basically that means that this is the parent. This is basically what? The subsidiary. The parent company acquired 80% shareholding on that date. Then the other company, which is basically called 𝐍, 𝐍 Limited, we have said that this one is basically what? This one is an associate. This one is an associate, simply because our parent company here acquired how many shares? As per the information which we have here, or basically the computation which we have done in note number 1, the parent company acquired 30% shareholding. This one acquired 30% shareholding. Are we given the date of acquisition? Yes, this one here, 1st July 2023. 1st July 2023. 1st July of 2023 here. Okay, 1st of July 2023. Like that, we have a problem there. Yes. So maybe let me type this manually, because this one should be 30%. But I can type that manually like that. Yes. So basically, that is the information which we have here. And that is the information which we have. And it basically means that 𝐍 is basically what? 𝐍 is an associate. Is what? Is an associate. So basically, in our case, now we have the group structure. We said then, even before we proceed to prepare the group account and maybe to do the other workings, we need to check whether there was a company which was acquired during the current year. And for you to be able to do that, you can only be able to do that by basically checking when the current year is ending. So if you go to the requirement here, the current year was ending on that year of June 2024. Was ending on that year of June 2024. So if that is the case, then we need to check which company was acquired during the current year. That year, June 2024. That year, June 2024. That year of June 2024. It basically means that this year started on the 1st of July 2023. That's basically what we know. 1st July 2023 there. Okay, this one should be this one should be 1st July of 2023. Yes, so that is basically when the year started. When the year started. Yes, when the year started. So take into account the year started on 1st of July 2023. So was there a company which was acquired during the current year? Yes, you can see that Z was acquired exactly at the start of the year, but now the other company, that is YEP, it was acquired, I think, 2 years back. 2 years back from the date of consolidation. None of the company was acquired during the current year. So I think having that now, we can go back to the additional information. We see, are there other workings which are required? So now in point number 1, the last paragraph here, we are told 𝐎𝐍 Limited also invested in half of the 10% debentures of YEP. The fair value of the non-controlling interest in YEP amounted to 240 million. Now, two items you are given here. So we are first of all, you're given the value of NCI. We are given the NCI at fair value. And automatically, once you're given this NCI at fair value, you have to recall why you are given that value. You are given that value for you to compute the goodwill using which method? The full goodwill method. Anytime you're given the NCI at fair value, you have to compute the goodwill using the full goodwill method. So therefore, in relation to YEP here, we're going to compute the goodwill using the full goodwill method. That is the first thing which we need to know. Also, we are told, other than our parent company having invested in shares of YEP, the parent company also invested in debentures. And therefore, these particular debentures here, where do we have the debentures? We have the debentures here. So these debentures which have been issued by this company here, that is YEP, half of them, that is basically 200,000, they are held by the parent company. They have been issued to the parent company. So when preparing the group statement of financial position, those particular debentures which are issued by YEP to the parent, we are going to exclude them. We are going to, or actually, we are going to eliminate them. So we will take this plus this, but we are going to eliminate half of this because those are debentures issued to the parent. Number 2, is also important for you to note that once the parent company acquired those debentures, the parent company paid for them. Now, the amount of money which was paid by the parent company, it should be part of this investment. You see, this investment, the examiner will not tell you, but the 200 million which was paid by the parent company in acquiring these debentures, it is part of this. Are we going to include that 200,000 paid by the parent in acquiring those debentures? No, we are going to exclude it. So that 200,000, we are going to exclude it from this value here, and also we will exclude it from that value. That is an investment within the group. It is an investment within the group. So I think no working which is required in relation to that, but we will need to remember that. Note number 2 here, so the group uses the full goodwill method. So even if that information was not provided, even if that information was not given, based on what you're given in note number 1, the NCI at fair value is upon us to know that when computing the goodwill, we automatically use the full goodwill method. We automatically use the full goodwill method based on the information which we have in note number, based on the information we have in note number 1, in note number 1. So, and then you're told, however, it does not amortize the goodwill. Instead, the goodwill is assessed for impairment annually. Impairment tests for the year which ended 30th of June 2022 revealed that none of the goodwill was impaired. Now, previously, goodwill was being amortized. I hope you know what is to amortize. To amortize is basically whereby, if, for example, you are at the parent company and you have acquired a subsidiary and you have determined the goodwill on acquisition, it is something like 40 million, you can make a decision that you are going to amortize that goodwill in the next 5 years. You're going to gradually write it off to 0 in the next 5 years. So that's what previously used to happen to goodwill. But currently, goodwill should not be amortized as per that information. Goodwill should be, or an impairment review or an assessment of impairment should be conducted at the end of each year. The parent company should assess, has the value of that goodwill reduced? And that is always based on like how the subsidiary is performing. If maybe the subsidiary is making losses, not performing that well, they can say that the value for that goodwill, in addition to acquiring that subsidiary, has done what? Impaired. So basically, also no working as far as that is concerned. No working which is required there. Not working. So we are told immediately prior to the date of acquisition, 𝐻𝐿 Limited, which is basically the subsidiary, revalued its non-current asset in readiness of acquisition. So this is now what we refer as the fair value adjustment. This is the this is basically the revaluation of assets by who? By the subsidiary company. The subsidiary company of the date it was being acquired, it revalued the assets. And actually it revalued two assets, equipment and patent. Now we are given the carrying amount here, and then we also given the fair values. Now what we need to do here is basically determine do we have a revaluation gain or loss? And basically in determining that, in determining whether you have a revaluation gain or loss, we compare the revalued amount with the fair value. Carrying amount, remember, is the same with the net value. For example, for equipment, you can see its carrying amount was 500. It was revalued upward to 580. So that increase, basically, which is an increase of 80, this one is a revaluation gain. And then that will also, we do need to do the same for the other asset, that is patent. So it was also revalued upward. It was also revalued upward. It was also revalued upward. Also revalued upward. Also revalued upward with an amount of 20 million. With an amount of 20 million. So this particular revaluation gain, number one, for example, this revaluation gain on equipment will be added to the PPE. Will be added to the PPE. This one will be added to the PPE, will be added to the group PPE in preparing the consolidated statement of financial position. And number two, we also need to compute something called the depreciation other charge. I hope you can remember how you are dealing with this. Anytime the subsidiary company revalue the asset on the date of acquisition and basically never accounted for that, and specifically there was a revaluation gain, you compute depreciation what? Overcharge. But basically we will see what we are told down there. So then the same, other than adding that revaluation gain of 80 million to PPE, we also account for it as a pre-acquisition revaluation reserve. So in computing the goodwill on acquisition, this will be one of the pre-acquisition reserve. The same case to that revaluation gain on patent. This one will be added. This one will be added. This one will be added to. This one will be added to the intangible assets. To the intangible assets. To the intangible assets, and then also it is a pre-acquisition. It is a pre-acquisition revaluation reserve. Then the other paragraph we are told what? We are told equipment and patent are on straight line basis of okay. There is something I think which is missing here. This one should be equipment and patent are depreciated. I think are depreciated. Depreciated. Yes, on a straight line basis over the remaining useful life. So basically, the reason why given this information, and I hope you can see down here, we're given the useful life, the expected useful life, we need to compute the depreciation other charge. So because in this case, once a subsidiary company devalued the asset but never accounted for that, we need to compute the depreciation what? Depreciation other charge. Let's compute the depreciation other charge. Depreciation other charge. And basically this depreciation other charge is basically by our subsidiary, and that is 𝐻𝐿 Limited. This is the company which revalued the assets. And I hope you can also be able to recall how were we computing this depreciation other charge. This one is basically computed. This one is usually computed by taking the revaluation gain the revaluation gain, revaluation what? Gain, we divide that with the remaining useful life of the asset, remaining useful life of the asset, and then we multiply that with the proportion of time. We multiply that with a proportion of what? The proportion of time. The proportion of time basically is the number of years, or basically the number of months we have from the date of acquisition to the date of consolidation. The date of consolidation is the date we are required to prepare the group accounts. Now, we will compute the depreciation under charge for the two assets which were revalued. The two assets which were revalued here, and that is plant and that is equipment and patent. Let me just copy this. So, and then I paste that here. So the depreciation under charge for equipment, and even before we do that, it's important for us maybe to determine the proportion of time, the number of years we have from the date this company was acquired. So I hope you can see this company, that is 𝐉𝐎𝐄, was acquired on this date. That is the date of acquisition. This one is known as date of acquisition DOA, and this is the date of consolidation. This is the date we are required to prepare the group account. So how many years do we have between those two dates? Between 1st July 2022 and 30th of June 2022. How many years do we have? How many years do we have here? Are they 2 or 3? Yes, automatically here we have 3 years, because the first year will end 30th June 2023 and 30th June 2024. 2024. Okay, so we have 2 years. So we have, that is the proportion of time. We need to compute depreciation under charge, therefore, of 2 years. How do we compute that? Using our formula here. I will take the revaluation gain, which basically have computed down here, this one. I will divide that with the remaining useful life, which is this one. And then I multiply that with 2. And basically we say you don't have to go back up there. So all the workings we are doing are appearing up here. Then we do what? We enter. That will give us depreciation under charge for 16 million. So do I need to do the same for equipment? No, I can just apply that formula down here. Like that. Because you can see basically you're picking these values. So what Excel will be able to do for us, it will pick this divided by this times 2. And maybe you can just confirm. How has that figure been arrived at? This one. So the formula for that will appear up there. The formula for that will appear up here. And I hope you can see how that figure has been computed. So the figures used must be highlighted in blue and also red. This one divided by that times what? Times 2. That one is very, very much correct. Aziz, you're saying what? You're saying patent is 1 year. Why 1 year? Yes, it should be. Both of them are 2 years because they were revalued. Actually, they were revalued on this. You see, the subsidiary company revalued the asset on the date of acquisition. So they were revalued on this date, 1st July. So basically, those are 2 years. Sasa? Yes, those are 2 years. So basically, how are we going to deal with this particular depreciation under charge? This depreciation under charge, number one, this number one will basically be deducted. This one will be deducted from the PPE because equipment is part of this, and also it will be deducted from the retained earnings of this company. The same case, this depreciation, although for patent, you see patent is part of intangible asset. We don't depreciate intangible asset. I hope you can recall. We refer to that as the amortization, but no problem. Let's just refer to it as depreciation. But basically, essentially should be amortization. Now, these ones will also be deducted from this, and it's the retained earnings of the other what? The other company, the retained earnings of the other company. Aziz, I give you a break once we are done with the workings. Aziz, and then we come back, we prepare the financial statements. Let me give you a break after. I don't know whether it will take us a lot of time. I don't know whether it will take us a lot of time, basically to finish the workings, and then I give you a break. We come back and finish. I don't think it will take us a lot of time. Let's just yes, because I think we have two notes. Yes, Aziz, let's just finish on the workings, and then I give you a break. We come back. Okay, so I think basically we are done with that. So then in note number what? Note number 5, note number 4, sorry, this one. We are told during the year which ended 30th of June 2024, YEP Limited sold the inventory, that is, to 𝐎𝐿. Remember, YEP is basically the what? YEP is the subsidiary. It sold some inventory to 𝐎𝐿. 𝐎𝐿 is our parent. 𝐎𝐿 is our parent. So these are sales between subsidiary and the parent. Now remember, if for example we were preparing the consolidated income statement, this one we said should be deducted from the group revenue and the group cost of sales. But are we preparing the consolidated statement of profit or loss? No. What therefore we are interested with here is basically the amount of what? The amount of unrealized profit. And basically what you're told in the other sentence is that YEP Limited marked up these goods at 25% on cost. 25% on cost. Half of these goods were still held by 𝐎𝐍 Limited at the end of what? Of the year. Quite simple. So what we need to do here is basically we compute something called URP, unrealized profit on inventory. Unrealized profit on inventory, and basically this unrealized profit by on inventory is always by the selling company. Remember, the selling company here was the YEP, which sold the good to the parent. That is the 𝐎𝐿. So therefore, this unrealized profit is by the selling company. That's basically what you need to recall always, is by the selling company. The company which sold made a profit, but basically we say that profit will not have been realized if some of the goods will not have been sold to that party. So therefore, this is unrealized profit by the selling company. The selling company is YEP. I hope you can also be able to recall the formula for this. How do we compute the unrealized profit? To compute the unrealized profit, we take the unsold goods, the goods not yet sold at the end of the year, and basically we multiply that with the gross profit margin. We multiply that with the gross profit margin. So in our case, we need to do that. We take the unsold goods, and basically we can have a working here. So the unsold goods will be equal to 300. Remember, the goods which were sold were 300. But basically we are told the goods not yet sold were half. So we get half of this. We can divide that with 2 to get half of that times the gross profit margin. Are we given the gross profit margin here? No. I hope you can see we're given markup. Markup is 25%. 25% is a quarter. So if our markup is a quarter, what is our margin? What will be our margin here? What is our margin? What will be our margin here? What will be our margin? I hope you can be able to recall how we were using that, how we were using markup to get what? How we are using markup to get margin, Yes, I hope you can remember that. Yeah, Christabel is saying 1/6, as is 2/5, 1/5. Now this one should be 1/5. This one should be 1/5. Margin should be 1/5. Okay, because 25% is the same with the 1 all over 5. 1 all over 5. So our margin should be 1 all over 5 plus the numerator. So it should be 6. Huh? No, sorry. 25%, 25% is a quarter. Is a quarter. Is that the position? Because that is 25%. That is 25%. 25% is a quarter, not 1 all over 5. Sorry for that. So therefore, this one should be 1 all over 5 like that. 1 all over 5. 1 all over 5. That's a yes, 1 all over 5. 1 all over 5. 1 all over 5. Yes. So that is basically our margin. So what we need to do here, I think we have already computed the unsold goods, which is 150. We multiply that with 1 all over 5. 1 all over 5 like that. So that will give us an unreleased profit of that. Now, this unreleased profit, number one, remember, this one should be deducted from the group inventory. The group inventory, we deduct it there. Number two, we also deduct this from the retained earnings. The retained earnings of the selling company. The retained earnings of which company? The selling company is 𝐲𝐻𝐃. We will also deduct that from the retained earnings of 𝐲𝐻𝐃. And I think we are basically done with that particular point there. We are done with that particular point there. So then finally, we are told 𝐿𝐍 Limited owed 𝐻𝐃 Limited 200 million as at the end of the year. With regard to the transaction note number 4 above, the books of 𝐿𝐍 Limited, which is basically now the parent, however, showed that it owed 𝐲𝐻 160 million. 𝐿𝐍 Limited had sent a check to 𝐲𝐻 Limited on 24th June of 2024, which was not received by 𝐲𝐻 until 2nd July. So automatically the amount of intercompany debt, I think similar to the other question which we did yesterday, amount of intercompany debt and equity, which is not the same, which is not equal. So this basically amount of intercompany debt and which is not the same. Amount of intercompany debt and basically which is not the same. So we need to basically determine how much amount is included within the receivables. How much amount is included within the receivables? How much amount is included within the payables? Within the payables, and basically how much is included within what? Or basically how much is our cash in transit? How much is our cash in transit? CIT. I think cash in transit is already given here. And the cash in transit is already given here. The cash in transit is the check which was sent. Are we given the value for the check which was sent? No. I think we are told the original amount of intercompany debt was 200. And then the company which was supposed to pay its books of account was showing that it owed the other company 160. So it is obvious that here the amount of cash in transit is the difference, which is 40. And then we said out of these two amounts, you don't even need to think a lot here. Always the amount which is this one, the larger amount, is the amount which is included within the receivables. This less amount is the amount included within the payables. Sasa? Yes. So the large amount is included within the receivables. This amount is included within the payables. The difference is the cash in transit. So that's what you just need to remember. So the cash in transit here will be 40 million. The amount of 200 is the one which is included within the receivables. The amount of 160 is the one which is included within what? The payables. So having that now, it basically means that when preparing your consolidated statement of financial position, this one will be deducted from the receivables, this one will be deducted from payables, and this one will be added to the group cash and bank balance. I think basically we are done with working. So what we need to do, maybe you can just take that short break of 10 minutes. We come back and then we compute the goodwill on acquisition, and then we prepare what is required in part B. So let's come back after that short break of 10 minutes. 10 minutes, we come back. Yes, so I want us to continue. I hope you are back. So if you're back, maybe just confirm so that we continue. Are you back? Yes, are you back? Are you back? Okay, so let's continue. Let's continue. So I think we have done all the workings which are required. So what we need to do then is we do what is required. Maybe you can start with automatically start with part A here. We start by computing the goodwill on acquisition of these two companies, the goodwill on acquisition of 𝐕𝐻 and the goodwill on acquisition of Z. So we just copy that and then we have it here. So we will start by computing the goodwill on acquisition of the subsidiary. So remember the subsidiary is basically 𝐕𝐻, and then we compute the goodwill on acquisition of the associate. So we start by computing the goodwill on acquisition of 𝐕𝐻, and recall in this case we are using the full goodwill method. We are using the full goodwill method. Why are we using the full goodwill method? Basically, I think we're given that some information in relation to that in note number 2, that the group uses the full goodwill method, and also based on what we have in note number 1, the fair value at the NCI at fair value, automatically we use the full goodwill method. So here we need to have two columns, and also our figures, we need to indicate are in million of shillings. 2 columns here. Yes, so what do we start with? We always start with the purchase consideration paid by the parent. Purchase consideration which is paid by the parent. Purchase consideration paid by parent company. And the purchase consideration paid by the parent company, we have that, I think, in note 1 somewhere. In note 1, this one. So this is the cost of investment. This is the cost of investment which was paid by the parent company in acquiring 80% shares of 𝐕𝐻, this one. So then to this, what do we add? We add something called the NCI at fair value. And I hope you can also be able to recall that when talk about NCI at fair value, this, in other terms, is the purchase consideration paid by minority shareholders. So when the minority shareholders acquired the remaining 20% of the shares, this is the amount they paid. Purchase a consideration. Purchase a consideration. Consideration by who? By NCI. So, and where do we have that information? We have that information still in note number 1, where we have the NCI at fair value. NCI at fair value, this one 240, this one 240. Yes, so we add those two values. That is the purchase consideration paid by the parent, the one which was paid by NCI. So we get basically a total of 1,200. And then now to this, what do we need to less? To this, we need to less the fair value of net assets acquired. Net assets which were acquired. And how do we compute this one? How do we compute the net asset which were acquired? The net asset which were acquired, this is computed by taking the parent company ordinary share capital plus the pre-acquisition reserves. So maybe what do we have here? Let's pick these items here, because we compute this by taking the ordinary share capital plus pre-acquisition reserves. So the ordinary share capital of our subsidiary is basically what we have here. This one. We also have share premium. We say if the question is silent, and actually you're given the share premium for the subsidiary, we always assume it is a pre-acquisition, unless told otherwise. Unless told what? Otherwise. So the retained earnings, do we take these retained earnings? No, I hope you can remember you see for the retained earnings, we take the retained earnings on the date of acquisition. And this one is given somewhere within note 1. Within note 1, that's why we're given the retained earnings of that subsidiary on the date it was acquired, this one. This is now what we call the pre-acquisition. The pre-what? The pre-acquisition. The pre-what? The pre-acquisition. Yes, the other thing we also need to check here is whether our subsidiary company devalued asset. Our subsidiary company devalued the asset on the date of acquisition. If yes, we need to consider the revaluation gain which occurred on the date of acquisition. And I hope you can remember in note number what? In note number 3 here, this company revalued 2 assets, equipment and patent, and the revaluation gain would be this 80 plus this 20. A total of what? A total of 100. I don't think we have anything else. I don't think we have anything else. So what we need to do basically is we get that total. We get the total, which will be 1,000, which will be 1,000. And because we are using a full goodwill method, we will take 100% of this. We will take 100% of that simply because we are using a full goodwill method. We are interested with the net asset acquired by the parent and the net asset acquired by who? By the subsidiary. So we take 100% of that, and then we get the difference here. Let me do away with those decimals. Yes, so we get the difference here. The difference basically, which will be how much? Which will be 200. Now the 200 basically, this is the goodwill on, okay. That is basically the goodwill on acquisition. That is a goodwill on what? On acquisition. So the goodwill on acquisition, the goodwill on acquisition is how much? Is 200. And I hope you can also be able to recall, there is somewhere in the additional information, we were given information that this goodwill was not impaired. This goodwill was not what? Impaired. I think in note number 2. Yes, I think in our case, we are done with that. Let's compute the goodwill on acquisition of the other company. And the goodwill on acquisition for the other company, we copy this. We paste it here. So we are computing the goodwill on acquisition of the associate. The associate, which is basically called Z, which is called Z. Yes. So now, when computing the goodwill of an associate, or basically when computing the goodwill of even a joint venture, we don't use the full goodwill method, because in an associate or basically in a joint venture, we don't have NCI. For example, in a joint venture, the parent company has got 50% shareholding, and then the remaining 50% of the shares are held by another entity. So in a joint venture, we don't have NCI. The same case in an associate. In fact, the parent company is a minority shareholder. So when computing the goodwill of an associate or a joint venture, is upon you to know you can only compute that goodwill using the partial goodwill method. But now when computing the goodwill of subsidiary, you can use the full or you can use the partial. So what we start with here is basically the purchase consideration which was paid by the parent. Let me just copy this. The purchase consideration paid by the parent. Purchase consideration paid by the parent, where do we have that? We have that in note 1 here. Amount of 240. Amount of 240. So here we don't have to add NCI. We have said we don't have NCI. Then we less this one. We less the net asset, the fair value of the net asset which were acquired. And equally, we will pick these items here. We copy this. We paste them here. We paste them there. Christabel is asking about the retained earnings. Christabel, basically what we have said is that what we pick here for the retained earnings, we take the retained earnings on the date of acquisition, because remember, we compute this goodwill we compute the goodwill on the date of acquisition. That's why we are saying we compute the net asset at the date of acquisition. You see, in this case, this share capital basically is not at the date of acquisition, but basically in this case, we assume that the share capital will not have changed. From the date this company was acquired up to date, the share capital has not changed. But we know retained earnings keep on changing annually. Sasa, yes. So these two items, unless order is the share capital and the share premium, we assume this one will not have changed from the date of acquisition. But for the retained earnings, you can't take this one because this one is at the end of the current year. We're interested with the retained earnings on the date our subsidiary was acquired. That's basically where we are working with this value here. Sasa, yes, because that goodwill has to be computed on the date of acquisition. So we are going to do the same. We are going to do the same for the other company here, that is Z, that is Z. So I will take its ordinary share capital, which is basically here, this one. Like in this case, we are saying that share capital of Z is not at the date of, this is not the ordinary share capital at the date of acquisition, but because the question is silent, we always assume that this was the share capital at the date our companies were acquired. It has not changed. Sasa, but you see something like the retained earnings, it is obvious. This one keep on changing. That's why we are not using the retained earnings which you have in the balance sheet. Equally for share premium and net otherwise, you also assume that this is the share premium which was there at the date our company was acquired. If it was not the case, the examiner will tell you. The retained earnings, we don't use the one in the balance sheet. We don't use this one. We don't use this one because it's obvious the retained earnings keep on changing. What we use is what we pick here is the retained earnings on the date of acquisition. Where do we have that? We have that here. This is the retained earnings of Z on the date it was acquired, this one. Then obviously this company didn't revalue any asset. So we don't have any revaluation gain like what we had up there. So we just need to add all those values. We need to add those values. We basically get 500. And remember here, we are using the partial goodwill method. So what we are interested with are the net asset acquired by the parent, which will be equal to this times the parent company shareholding in Z. The parent company shareholding in Z is what we have here, 30%, this one, 30%. And then we need to make this figure negative. We basically multiply this with the -1. I hope you can see what I've done. I've taken this times 30% and then times -1 to make it a negative. So the net asset which were acquired had a value of 150 million. So what is the difference? What is the difference? The difference in our case is 90 million, and this 90 million is the goodwill on acquisition. The goodwill on acquisition. The goodwill on acquisition. The goodwill on what? On acquisition. The goodwill on acquisition. The goodwill on acquisition. As is, I think I've explained, when computing the, I think I've explained that in length. When computing the goodwill of a joint venture, when computing the goodwill of a joint venture or even associate, you can't compute that using the full goodwill method. The goodwill of the subsidiary is the one which can be computed using the full goodwill method or partial. When computing the goodwill of associate, goodwill of joint venture, you always use the partial. You always use the partial. So because, for example, I've said in a joint venture, we don't have NCI. We have 50% shareholding. There is no minority shareholder. In an associate, in fact, the parent company is the minority shareholder. So when computing the goodwill of associate, joint venture, the examiner will not tell you, but you use the partial. Use the partial. You use the partial. Yes, it says full, but that one only applies to the subsidiary. That one only applies to the subsidiary, not the associate. Because I hope you can see there is nowhere we even given the NCI for who? For the in associate. So though we are saying in an associate, we don't have it. In the parent company is the associate, is the NCI, that is the NCI. Okay. So we are done with that. I think we are done with part A. We have managed to compute the goodwill on acquisition. Then basically what we need to do here is to finalize by basically preparing what is required in part what? In part B of the question. In part B of the question, let me have it here. We are required to prepare the consolidated statement of financial position S at the end of there. Basically, for us to be able to do this, we need to go back to our group structure. And remember, in our group structure here, we have a parent company, a subsidiary, and basically what? Associate. So how do we prepare the consolidated statement of financial position? We prepare that one by combining, consolidating similar items of asset and liabilities, those of the parent, that is 𝐻𝐶𝐒, and those of who? Of the subsidiary, that is 𝐻𝐿. Do we consolidate those of the associate? Automatically no. Automatically no. So what you're going to include in the consolidated statement of financial position, as far as this company is concerned, is something called the investment in associate. Investment in what? In associate. So we will only combine similar items of asset and liabilities, those of 𝐻𝐿, those of yeah. So I think here we just need to have a single column. We copy. We paste that here. Then I need to copy all this description here. All this. I copy all that. Control C. I need to paste that here. Control V like that. Yes. Yes. So basically, to prepare this, we are saying we combine similar items of asset and liabilities, those of the parent, those of the subsidiary. So we will start with the PPE, property, plant, and equipment. Property, plant, and equipment. This one will be equal to, we just need to develop a formula here. So this one will be equal to whatever you have here, plus what we have here, what we have here. Yes. So basically we enter like that. Huh? It's coming to 36. Okay, it is correct, basically. Now, what we need to do, we need to apply that formula. We need to apply that formula to all items of asset. But remember, some of the items of asset will need to be adjusted, but we're going to do the adjustment later on. No problem. No problem. No problem. We'll come back and do the adjustment later on. Then we also need to do the same to the items of liabilities. Items of liabilities here. We need equal to combine items of liabilities. Remember, we don't combine items of equity. So we will start from where we have this one, that is 10% debentures, this one. Where do we have those particular debentures? We have them here, this one. Plus this, we enter, and then we will basically apply that formula to all the other items. Yes, to all the other items there. Yes, but automatically some of the items, we know they have adjustments. So we will come back and do the necessary adjustments. So basically, maybe you can start with the PPE before we deal with the component of equity. So for the PPE, we need to check, do we have any adjustment? And remember what we said is that once you highlight that cell, the formula for computing this will appear up here. So any adjustment I want to do, I will do it from up here. Sasa? Yes. So basically, this figure for PPE, I know it needs to be adjusted. Number one, to this value, I'll basically need to add the revaluation gain. I hope you can remember this revaluation gain, this one. And then to this, I also need to less the depreciation other charge. I hope you can remember the depreciation other charge. This one, I need to less that. Okay. Okay, sorry. Let me redo that afresh. I think the formula disappeared here. I don't know what happened. Okay, sorry. I think this was supposed to be minus. Yes, minus. Yes, I think it's okay. Yes, because I've added this revaluation gain, which is highlighted in purple, I need to less depreciation other charge, this one, 16. Is there anything which is remaining in relation to the PP? In relation to the PP, anything which is remaining? I don't think so. I don't think so. I don't think we have anything else which is remaining. So I think I can just enter. That will be the final value. What about the intangible asset? This one will also be having some adjustment. I'll highlight that. My formula will appear up here. Any adjustment, I'll do it from up there. To this, I need to add the revaluation gain, this one. And then I minus these amortization, which are not been accounted for this one. I do what? I enter like that. Yes. So that basically will give us 7 what? 716. So what about this investment? This investment you also need to make some adjustment, because there is something you also need to remember the question we did yesterday. So this investment, anytime you're given an investment here, this includes the amount of money which the parent company invested in the subsidiary and also the associate. That amount should not be included here. So to this amount of 14, I will deduct a number of items. To this, I will less the amount which was paid by the parent company in acquiring shares of the subsidiary. This one is included within that amount of 14. I will less that. I will also less the amount which was paid in acquiring shares of associate. This one. There is also something I need to less here. Remember this information which you are given here, that 𝐎𝐍 Limited, which is the parent, invested in half of the 10% debentures of 𝐎𝐻. So the debentures issued by 𝐎𝐻, these ones, they have a value of 400. So unless told otherwise, the parent company always pay an amount equivalent to the par value, equivalent to the value of those debentures. So the parent company paid half, or paid half of this. Paid how much? 200. So that 200 is still included in that investment of the parent. So to this, we also left 200, like that. I hope you can see what we have done. We have basically deducted the amount paid in acquiring shares of subsidiary, amount paid in acquiring shares of associate, and the amount paid in acquiring the debentures. And I hope you can see that amount is coming now to 0. I hope you can see now the amount is coming to 0, because this is basically what the parent company had paid, or the amount the parent company had invested in the two companies. So that one should not be included here. Now instead, what do we include here? What do we include here instead? So there are a number of items you're going to capture here. I need to create some more space here. Maybe I can just insert a number of rows here. Yes, let me insert like 2 of them. There are 2 items I need to add here. One, I need to add the goodwill. Okay. I need to add the goodwill here. I need to add the goodwill on acquisition of the subsidiary. The goodwill on acquisition of who? The subsidiary. Remember, the subsidiary in our case is 𝐎𝐻 Limited. So that goodwill should be recognized here as an asset. And we have that goodwill up here, this one. That one will be recognized here as an asset. Now, do we include the goodwill of an associate here? Who can tell us? Do we include the goodwill of an associate here? Do we include the goodwill of an associate? Do we include the goodwill of an associate here? Do we include that here? Yes or no? I'm waiting for your answer. Yes, so in this case, we don't include the goodwill of associate here, even the goodwill of joint venture. So we only include something called the investment in associate. We include something called the investment in what? Investment in associate. Investment in what? In associate. Investment in an associate. Now, the investment in associate, this one we usually compute it. No, do we need to do a separate working? No. Remember what we did yesterday. To December, we need to take the cost of investment. How much amount was paid by the parent company in acquiring the 30% shares of Z? Is this one 240? And then now to this, we add what? We add, and I hope you can see whatever I'm doing is appearing up there. To this, we add the parent company or something called the group share of the post-acquisition retained earnings of the associate. So the group share of the post-acquisition retained earnings of the associate. So basically what we need to know is that at the date this company was acquired, its retained earnings was this one, 200. This one is called pre-acquisition. But now if we go back to the balance sheet of that company that is Z, you'll be able to see it has a retained earnings of 300 or 500, sorry, this 500. Now this 500 is basically pre-acquisition and post-acquisition. So what we need to pick here is the post-acquisition retained earnings, which will be equal to this, which include both pre and post. So to this 500, we less the pre-acquisition retained earnings. What are we left with? What we are left with is the post-acquisition retained earnings of Z. We get the parent company share of that. The parent company share of that would be 30%. Would be 30%. Would be 30%. So it should be 30% of 300. That should give us 90. Should give us 90. And then to this, in case there are those questions whereby you can be told the investment in associate had impaired. That investment which was paid by the parent company, the associate, had impaired. So that impairment clause, you list it here. But I hope you can remember in our question, I think in note number 2 somewhere there, we were told there was no any impairment loss. So here we don't have any impairment loss. I hope you can see how we have computed that. We have taken the cost of investment to 40. We have added the parent company share of the post-acquisition retained earnings of 𝐻𝐿, and then you have deducted the retained earnings. So denote the retained earnings, the impairment loss. So, and basically that should give us around a figure of, this one is 240, and this one will come to 300. 30% of 300 should be 90. That should give us roughly 330. Let's see whether we will get 330. Yes, that would be 330. 330. Yes, like that. So basically nothing else to be recognized here. I think we are basically done. Let's go to where we have current assets. Current assets. Current assets. Current assets. Current assets. I don't know whether there is okay, let me see. Yes. Now for the current asset, we start with the inventory. This one will have an adjustment here because we have a component of unreleased profit. So we will need to less that unreleased profit. This one 30. We less it from the group inventory. From the receivables, that one will also have some adjustment. We less the amount of intercompany debt, and basically the amount we are deducting from the receivables is this 200. This 200, we less it. Financial assets, no adjustment for that. And then the cash and bank balance. So to this, we need to add the cash in transit. We need to add the cash in transit. This 140. This 140. And I think in our case, basically we are done with the asset. We are done with the assets. So what we just need to do is we do the outer sum here, and we get the figure there of 7920. 7920. Basically, we can arrange this. Yes, we arrange that. I don't know whether there is any question in relation to what you have done there. Any question in relation to what you have done for the assets? Any question on in relation to what you have done for the asset? I hope you have understood what you have done there. Is that the position? Christabel, Sharon, T, Josephine, Aziz, are we together up to that point? 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 Okay, sawa. So let's now move to equity. Equity, remember, we said items we don't consolidate directly. So for example, ordinary share capital, this one we only take that of the parent. Ordinary share capital, we will take that only that for the parent. Reason being, and that one for the subsidiary has been used in the computation of goodwill. Anything we have used in the computation of goodwill, we don't include it here. And together, it's the same case with the share premium. Share premium will also pick that of the parent. I'll basically pull that formula down there. So the share premium for the parent will come down there, which is basically 400, this one. Now the retained earnings, we need to compute that one. We need to have some working for that. Though we said in an examination setup, I'll basically advise you not to bother yourself computing this one. But we will see. There is something also we said we should compute, and basically we include here called the non-controlling interest. The non-controlling interest. Non-controlling what? Interest. Also, I think we will compute that. And I think before we compute the two, maybe let's see the adjustment to be made to these items of liabilities. Now for the debentures, this one will have to be adjusted because some of the debentures which were issued by our subsidiary, this one, half of them are held by the parent. So to this, we are going to less 200. The debentures issued to the parent. What about deferred tax? Actually, for any question for group, any time you come across an item for tax, that is always a free mark, no adjustment. Trade payables, this one will also have some adjustment because we have amount of intercompany debt. So how much amount are we supposed to raise from the payables? This one, 160. Any adjustment for tax? No adjustment for tax. Then we have these dividends. These dividends. Will this dividend be having some adjustments? Oh, sorry. Yes, because I think what is picked there is the proposed dividends. Remember, these are the dividends which are supposed to be paid by the parent and also the subsidiary. Do you have any adjustment for that? Any adjustment for this? Yes, there will be some adjustment for that. A reason being, there will be some adjustment for that because these dividends are supposed to be paid by the parent to its shareholders, but now this proposed dividend by the subsidiary, 80% are payable to the parent. Are payable to who? To the parent. It's like amount of intercompany debt. Amount of intercompany what? Amount of intercompany debt. So basically, what we need to do is to eliminate the dividends which are payable to the parent. This one. So from the proposed dividends, we are going to less the dividends which are payable to the parent. The dividends payable to the parent should be 80%. Should be 80% of the dividends of the proposed dividends of the subsidiary. The proposed dividends of the subsidiary are 200, these ones. So those dividends are payable directly to the parent. Are they supposed to be recognized here as a liability? No, because that is equivalent to amount of intercompany debt. Equivalent to amount of intercompany debt. Yes, and basically that will give us 240. and there's no information which you're given in relation to this, yes. So I think we have that. So two items are basically remaining. That is NCI here, NCI, and basically what, and a group retained earnings. We compute those two items, or we just ignore them? We compute those two items, or we just ignore them? Because basically, if, for example, that question, or you leave it at that point, if you leave it at that point, automatically you'll be able to get all the marks. I hope you can also be able to recall, like in a file, usually you are told those two items, the retained earnings, the group retained earnings, the NCI, you can just do what? You have to ignore them. And I also hope you can remember the other question we did yesterday. The computation of those items was also quite demanding. I think we can just ignore them, because even in an examination setup around the, you'll be able to compute that. Because now what is marked here are those particular entries. Are those particular what? Entries, those particular entries which we have there. Those entries which we have there. I think if you're able to do it like that, if you're able to do that question like that, automatically will be in a position to score all the marks. Yes, I think we can just ignore those two items, the group retained earnings and also the non-controlling interest. Non-controlling what? Non-controlling interest. Non-controlling interest. Yes. And basically that now brings us to the end of that particular question there. It brings us now to the end of that particular question there. And I think that also will be the end of that topic for group accounts. Maybe during our revision, we'll be able to come back and do another question. Do another question for group accounts, maybe in preparation for your examination, because these you never know. It may be tested in December examination. So I don't know whether there is any question before we call it a day. Any question before we wind up?